Alright, let's get right into today's video. What if the next global conflict isn't fought with bombs or bullets, but with a war where their weapons aren't tanks or missiles, but trade deals and interest rate changes? It sounds crazy, right? But for over a decade, China has been quietly playing a long game. Not with armies, but with algorithms, interest rates and currency controls. Beneath the headlines about trade wars and tariffs lies a more subtle yet more dangerous battlefield, the war over money itself. Today we're diving deep into this shadowy world. No spies, just number crunchers and economic wizards. We'll uncover how China is wielding the power of currency, why it is a double-edged sword, and why it could reshape your financial future more than you might imagine. Stick around, because this is a story filled with twists, turns and figures that will leave you saying, I had no idea. Act 1. The shadowy world of currency wars. Think trade wars are dramatic. Well, they make headlines, but they've got nothing on currency wars. These covert battles happen behind closed doors, twisting financial gears to give a nation's exports an edge. It is a silent game of economic chess, where the goal is simple: outmaneuver your rivals and make your goods cheaper on world markets. But here's the twist: proving these manipulations is harder than spotting a spy. Countries rarely come clean about it. So how do we spot these sneaky currency moves? How do they work? And why should you care? Let's start at the beginning. Act 2. Inside China's currency playbook. Picture this: you're shopping online, say for a trendy piece of tech, or maybe some stylish shoes. You're comparing prices, and wouldn't you know it, products from China are surprisingly affordable. But is that just good manufacturing or something more? Enter currency manipulation, a tactic often used by major economies to boost exports and make imports costlier. By tweaking their currency values, they can change the price tag of goods on the world stage. And China, well, it's a master of this game. They've been accused of keeping the value of their currency, the yuan, lower than it should be. This makes Chinese goods seem cheaper to buyers worldwide. It's a strategy that has fueled their rise as a global economic giant. But how exactly do they pull off this balancing act? Until 2005, the yuan was pegged to a basket of major currencies, a system that provided stability but limited flexibility. Then came the managed float. The yuan's value started to be influenced by market forces. But wait, it's not entirely a free ride. China still sets limits, targeting a specific exchange rate band. If the yuan strengthens too much, making exports less competitive, China steps in to buy yuan and push the value back down. That way, Chinese goods stay affordable and their exports keep flowing. But it's a tightrope walk. Managing the currency helps protect jobs and industries, but it also invites criticism of unfair trade practices. China's playbook is complex, but one thing's clear: when the yuan weakens, Chinese exports become more competitive on the world stage. Act 3. The global ripple effect. Now let's zoom out from Beijing's financial halls to the world stage. When China makes subtle moves with its currency, the repercussions can be surprisingly widespread. It's like dropping a pebble into a pond, creating ripples that reach far and wide. Imagine you're living in an emerging market. Your country's currency suddenly takes a hit due to China's currency adjustments. This can spark a wave of capital flight, meaning investors rush to move their money out of your country's markets into safer assets like the US dollar or gold. As a result, your local currency weakens even more, making imports like food and fuel costlier. This directly impacts your life. Basic commodities become more expensive, potentially fueling inflation and affecting your everyday expenses. It's a domino effect. One nation's currency woes can trigger a chain reaction, influencing exchange rates, inflation, and investment strategies across the globe. But hold on, there's more. Central banks don't just sit idly by. They have tools at their disposal, mainly interest rates. Let's say a country's currency is weakening, making imports costly and stoking inflation. To counter this, the central bank can raise interest rates. This attracts foreign investors looking for better returns, stabilizing the currency. But it comes at a cost. Higher interest rates mean borrowing becomes more expensive for individuals and businesses. Investment and economic growth might slow down. It's a tough balancing act for policymakers worldwide. They're constantly assessing global cues, anticipating shifts in currency values and fine-tuning interest rates to keep their economies stable. It's a never-ending game of economic chess, and every move counts. In fact, it's getting so intense that the world's leading economies are now divided into two camps, each trying to outmaneuver the other. Team Dollar, led by the United States, favors a strong dollar. This can help contain inflation, but makes exports more expensive, potentially slowing down economic growth. Team Yuan, largely driven by China, aims to reduce reliance on the dollar. While it can boost Chinese exports, it might lead to currency wars and destabilize global trade. The stage is set for an epic battle of economic titans. And as always, it's not just about money. It's about influence, power, and the quest to stay ahead in an ever-changing global game. Act 4. Escalation, the digital yuan, and the future of currency warfare. Now let's fast forward to a near future where the currency wars take a quantum leap with the rise of digital currencies. China's digital yuan, also known as the ECNY, is not just a payment innovation. It's a potential game changer in the ongoing battle for economic supremacy. Once widely adopted, the ECNY could enable China to implement policies that promote domestic consumption, bypassing the traditional banking system and giving China's government unprecedented control over its currency. Imagine this scenario. After years of careful calibration, China decides to increase the value of the yuan to reflect its growing economic strength. This makes Chinese exports slightly more expensive. But hey, that's the price of progress. However, in a surprising turn of events, Team Dollar responds by reducing interest rates, making the US dollar less attractive and causing its value to drop. Suddenly, the playing field shifts. Chinese exports become more competitive again. The currency war escalates. The battle isn't just about manipulating exchange rates anymore. It's a fight for influence. The stakes are higher than ever before. The United States, with its massive economy and status as the world's reserve currency, flexes its financial muscle. China counters by boosting domestic consumption with the ICNY, aiming to reduce its dependence on exports. In this new phase, both nations tailor monetary policies to suit their economic goals. The US raises interest rates to attract foreign investment, while China keeps rates low to encourage borrowing and spending domestically. It's a delicate dance, and the outcome remains uncertain. Will China's digital currency accelerate the Great Decoupling, a global split between dollar-aligned and yuan-aligned economies? Only time will tell. But one thing's for sure, the future of currency warfare looks digital, dynamic and highly competitive. Act 5. Turning knowledge into strategy. In a world where currency wars are escalating, knowledge is your most potent weapon. Staying informed about central bank signals, monitoring global economic shifts, and diversifying your investment portfolio can be your best defense. Here are 5 actionable steps to help you navigate these turbulent waters. Step 1. Watch central bank signals. Central banks don't just set interest rates, they send messages about their nation's economic health. By understanding their announcements and policy changes, you can anticipate currency moves and adjust your financial strategy accordingly. Step 2. Global diversification. Don't put all your eggs in one basket. Diversifying your investments across different countries and currencies can help buffer against currency fluctuations and economic shocks. Step 3. Macroeconomic moves. Stay informed about major economic events. Is a country raising interest rates? Has there been a surprise currency devaluation? These events can impact your investments, so keep informed. Step 4. Real-world opportunities. Currency fluctuations don't just affect markets, they influence everyday costs. From travel to groceries, staying aware of exchange rate changes can help you make informed choices. Step 5. Smart action. Knowledge is only powerful if you act on it. Whether it's adjusting your investment strategy or re-evaluating your financial goals, taking action based on your insights can make a significant difference. Navigating these turbulent times doesn't mean sitting on the sidelines. It's about arming yourself with knowledge, diversifying your portfolio, and making informed decisions. In this intricate game of global economics, your financial future is in your hands. Are you ready to play smart? So coming back to our initial question, is China winning the currency wars? It's not a simple yes or no answer. China's currency strategy is a carefully calibrated balancing act. On one hand, a weaker currency makes its exports more competitive, driving economic growth. But it also fuels inflation and increases the cost of imports. Despite the complexities, China's strategy seems to be working. Its exports remain strong and its economy continues to grow. But the true test will be whether it can manage the challenges of a rapidly evolving global economy without triggering a broader currency war. And that's a wrap for today's video. If you enjoyed this journey into the hidden world of currency wars, give us a thumbs up and subscribe for more enlightening content. And remember, in the intricate game of global economics, your knowledge is your most valuable asset. Until next time, keep learning, keep growing, and keep dominating the financial world. Thanks for watching.